contrary to a lot of the theoretical academic research, we do not believe the stock market is efficient. We believe, due to day trading, extreme emotion in the marketplace, and certainly a lot of memories of investors of past major declines of 2008, 2009, the market is fraught with many opportunities and short-term aberrations. So in consequence, we believe that not all information is priced into stocks, and that there are opportunities to take advantage of these anomalies in the marketplace. In consequence, our continued view, and it has been our view for many, many years, and that's why we get involved in a lot of small cap stocks, which are probably, due to their lack of following by investment analysts and institutions, probably have the greatest bit of inefficiency of any sector or size in the stock market. We look for a number of factors in terms of our stock search. We look for companies that are trading well below tangible book, low price earnings and cash flow multiples, hidden assets such as real estate, tax loss carry forwards, maybe even litigation. It is a very tedious process, but these factors are very important in terms of our discovering stocks that are undervalued and not followed by the masses that we're very comfortable with, that we can put in our portfolios for good capital gain potential. The buy-sell discipline is quite interesting. In terms of when one sells, naturally we have our buy and sell targets. If the stock reaches our sell target, we will obviously sell it after doing incremental work to make sure nothing has changed, new positive factors that might encourage us to increase our targets. Having said that, we will sometimes sell a stock for one of two reasons. One, on a macro basis, if we find the economy or something on the macro side is turning negative and we're fully invested, so we will sell the most expensive of our cheapest stocks to increase our cash reserve. We will also, on a second basis, on a micro basis, we will sell the stock if it reaches our sell targets and nothing has changed for us to increase our sell limits. Taking a loss in a security is one of the most difficult disciplines in the investment business. We will often take a loss in a stock if our initial objective or expectation in a rationale of buying a security has changed. In other words, if we discover that management isn't what they said they were or what they were going to do hasn't been accomplished, or two, if various states of nature have changed, if new competition comes in as well. So we have no problem taking a loss if it'll save us a lot of grief in the future, and two, if circumstances have changed. And another reason we may take a loss is that we might find new stocks to be bought and we're fully invested, so we'll take a slight loss in a company to use those funds to purchase something else that will do quite well. One of the problems of being a deep value investor is once we discover a stock to be purchased, you're full of aggressiveness. You want to buy it because you think the stock could go up 50 or 100%. However, one major factor in that is that we underestimate emotion in the marketplace, such that if we find a cheap stock and we start to buy it, quite often we're too early. However, having said that, we look at the long-term trend in the market and where we think the stock's going to go, and in many cases we believe it's far better to be a year early than a day late. And a good example of that is the old Nortel, which no longer exists.